This is Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Elconin. We're joined by Chris Versace. He's a portfolio manager of the Thematic Growth Portfolio. Chris is also a financial columnist, equity analyst, and he's got more than 20 years of experience in the investment industry. Chris, thanks for joining us this morning.
Oh, happy to do it. More than happy to be back with some old friends at Benzinga.
You mentioned this is your ninth radio spot this week, so what have you been telling everyone else about this week's market action?
Well, the two big questions or three big questions are, hey, we saw this big whipsaw in the market. What does it mean? What's causing it? Was this a big surprise? What should investors be doing? All of the usual questions, right, that you would expect us to get. And to me, it kind of really dials back a little bit. I think a lot of people saw the last 5 or 6 trading days and went, oh, my God. But if you were to trace back, the last couple months, we've seen a lot of data, both, here at home and outside the U.S., particularly China, that's really pointed towards a slowing global economy. And, at the same time, we've seen the market, continue to ratchet higher. And, to me, I look back and I say, geez, the S&P 500 at one point was trading well north of 17 times with 2% earnings growth, for 2015 over 2014. But the first 2, maybe 3 quarters were going to be flat to down. Yeah, something, at some point, something's got to give. Yeah. And I think we've seen a confluence of factors that have led to that.
Absolutely. And of course, everyone's coming out with advice on how investors should navigate, a dip in markets like this, whether you should just stick on the sidelines and hold, stay the course, or whether you should be buying some of these stocks on discounted prices. I mean, what do you think are some solid strategies for investors to take during these type of markets?
Well, they all sound pretty good, right? I was just, tracing back, if you look over the last couple months, you've got, Apple is down 20%, Skyworks, which is one of the names we own in the Thematic Growth Portfolio, down some 24%. Facebook in the last month has fallen, 10%. Disney down 17%. And you've got others too, Amazon's, Starbucks, and a bunch of others that all kind of come in. And to me, the thing that we need to do is to really reassess the growth expectations, because that's really the underlying thing, right? If a company is going to continue to deliver on the top line, if their margins are going to continue to expand, if you're Starbucks, for example, because you've got falling coffee prices, or maybe the airlines, because you've got falling oil prices, right? You need to understand that and understand what the direction is in their earnings, particularly relative to expectations, okay? Once you do all that, you ask questions like, what's your catalyst? Okay, is there anything coming up? Like for Apple, we know fairly soon that we're going to have a new round of iPhones, maybe an iPad Pro, maybe something on the TV, things like that. So what are the reasons to buy? But then at the end of it all, you've really got to look back over history and do a lot of, that what I call valuation homework, right? How is this stock trading relative to prior peaks, prior troughs? And you have to look at it on, multiple bases, whether it's, PE, relative PE, dividend yield, so you can really assess what your opportunity here is and what your downside is. And that's, Brianna, even after some of these pullbacks. So a lot is going on, in my opinion.
Absolutely, and I think that's a great point you make. In times like these, we have to reassess some of our growth expectations for these companies, especially when you have all these external factors like low oil prices and plummeting coffee prices as well. Are there any names that kind of stick out to you that do have stable, steady growth ahead, given some of the fundamentals of the company?
Well, let me twist that question around a little bit
Sure.
and say, hey, we've seen some of these names pull back. Are there ones that maybe, hey, I'm rolled up my sleeves, doing a little extra homework on, maybe kind of, hey, these look like they're hitting the, a point where we can start adding them to the Thematic Growth Portfolio. Is that okay?
Yeah, absolutely. First, can you tell us a little bit about the Thematic Growth Portfolio?
Oh, that's so sorry. Sometimes
No
I get,
problem.
so excited, I just kind of dive right in. So the thematic growth portfolio, it's based on the way that I look at the world, which is through thematics, which to me are assessing, the tailwinds that come about because of shifting economics, demographics, psychographics, which is kind of a big fancy word for how, where, why consumers, businesses, and other entities are buying or consuming. We also look at the shifting technologies that are out there, as well as any type of regulatory mandates and some other factors, which when you pull them all together, right, really identifies these demonstrative tailwinds, as I said, and we look for opportunities that cut across industries. So the view is much more horizontal than, say, Wall Street research is vertically driven, because we want the best exposure to the tailwinds. I don't really care so much, it's retail, it's banking, or it's tech or this or that. We're looking for, again, companies with great exposure to these tailwinds on a risk-reward basis that we can add and, see things play out over, 6, 12, 18, sometimes even 24 months.
Okay, great. So then go back to what you were going to tell us a little bit about stocks that you would consider adding to that right now.
Sure. So, if we take a look at some of these pullbacks, I'm asking some of these same questions, looking at our risk-reward, greater risk than reward. I like to see, at least what I call net 20% upside. If I can see more, even better. But, looking at some of these names that have pulled back here, Starbucks with these falling coffee prices. We take a look at, Disney, like I said, down 17%. And on the catalyst to me coming up is the continued move for the Disney content licensing, merchandising machine that it is for Star Wars. More Marvel movies. We've also got, a number of upcoming Pixar movies, everything from Frozen to, one of my favorites I'm looking forward to, and this is going to be a total geek moment, The Incredibles 2, because I thought the first one was fantastic. So, things like that, where I can see the signposts ahead. But another one, too, that I'm looking at, candidly, on the pullback would be Netflix. Another one would be LabCorp. And you might say, LabCorp? How does that fit in with anything you just mentioned, Chris? And I would say that it fits in with one of my themes, which is aging of the population, right? It's no secret that as we look around, whether it's in China, Japan, even here in the U.S., our population is skewing older. And that puts a lot of demands on companies to address, certain needs. So, certain aspects of healthcare will be big, assisted living will be big, and the like.
Chris, do you take a look at the charts at all, looking at the technicals? When you look at something like Disney, it's fallen from $120 down to $90. Is that something you look at when you're analyzing these companies?
Well, I've been doing this a long time, and, despite what some of my friends would say, I would come back to you and say, there is no silver bullet, okay? You really have to take a look at what the fundamentals are. You need to look at, how, as I mentioned before, how the stocks have traded over time within their valuation ranges, looking for things that might cause them to break out up or break out down. But, yeah, do I look at the charts? Yeah, I do. I'm going to look at some of the relative strength, the MACDs, whether it's oversold, overbought. And then to me, that's kind of the tail end of my analysis, as I try to fine tune what's going on. And I'll also use, some of those indicators too. If we're up big, like for example, we were up big in USA Technologies, we were up big in Mobileye, we were up, huge in Skyworks. Really over the last year or so, we said, okay, getting a little concerned here. Things are looking a little overbought. Maybe we should, trim back, and we did.
What about oil right now? Back down, trading under the $40 level. It's like, what are your expectations for this commodity? Is it going to drive lower? Are we going to go up to $100 per barrel?
That's the big question. And, from my perspective, I see the fall in oil due really to two factors. One is supply, as in excess supply. But the other side of the equation is always demand, right? As anybody who's taken economics 101 knows, they beat supply, demand into your head. And,
Yeah.
clearly this is one of those issues. So if we go back to what I was, saying earlier, we've got over the last few months a lot of data that points to this contraction in China, and we're seeing that play through the market now as a lot of people have kind of realized what the potential impact of that is. We've also seen a slower U.S. economy, right? And we can look at various factors, durable orders, industrial production, but one of the things I like to trace back is truck tonnage and weekly railcar loadings. And they have fallen really through, June and July. So the manufacturing activity has slowed a little bit here, so I think demand's a little slower here as well. And we're seeing that crop up in the Atlanta Fed's numbers. They have this great running forecast called GDP Now, and they see the current quarter shaping up to be about 1.3% in terms of GDP, down from 2.3% last quarter. Not the right vector, certainly not the right velocity. So I do think we have slower global growth, and I think that is going to help restrain demand for oil. And, one of the areas that we've looked at is the airlines. And what's interesting about the airlines now is, you can roll up your sleeves and possibly look at companies like, Virgin America, JetBlue, or even American Airlines, which we added to the Thematic Growth portfolio. But there's also a new ETF out there, which was a little surprising to me when I first heard about it. But in this instance, it's kind of fantastic because, airlines, one of the greatest costs is jet fuel. Jet fuel is, trades very closely to oil. And obviously, as oil has fallen, so will jet fuel. That's great for airline margins. But in this ETF, its ticker symbol is JETS.
Yeah, Jets. We've actually had the CEO of the company that runs that ETF on our show before, too.
Yeah, so that's one way to look at it. And, to me, I like ETFs. I like these, let's call them designer ETFs, because they allow, exposure without really having to hone in on any one particular company. And I think for the individual investor, it's a nice way to play something that's happening, remain diversified so you're not relying on any one particular company. And it's just an easy basket approach.
What about some of these specific companies in the oil sector? Of course, we heard about Schlumberger. It says it's going to acquire that oil field equipment maker Cameron International Corp this morning. And at the valuation they're giving for it, it kind of seems like the deal made sense when oil was higher. But oil at these levels, I don't even know. Is this the right time for M&A of that type?
Well, a lot of it depends on what they're seeing kind of under the hood, right? Having worked inside a couple of different investment banks, the one thing that they're privy to during the due diligence, or the due diligence, as we call it, is kind of seeing what the expectations are, the real expectations, not necessarily what the market sees. But, we also need to understand what potential synergies they have as they do this. Sometimes when companies get vertically integrated, it can be a good thing. Other times, not so much. So to me, it's kind of we need to wait and see. So that's, anything they can do to, improve their competitive offering, shore up these competitive moats around their businesses, I think it's fantastic. I will say that one of the most impressive moves that I've seen like that, if you want to think about it, not to shift gears on you, is when Comcast bought NBC Universal. Because all of a sudden, they had a huge moat around their business, content, right, which is something that most of its competitors, from Cox to Time Warner Cable and these other cable companies, didn't have anymore. So, I need to roll up the sleeves, but if this is that kind of a move, then it could be a good thing long term.
Really interesting that you just compared it to the media sector. I mean, that's something that we have seen a lot of consolidation, and some of these older media companies are struggling amid newer media. We just saw NBC, make an investment in BuzzFeed. They've also invested in the parent company of, what was it, Gawker, and all of those popular news blogs. So really interesting comparison. Is there anything else right now, like on your long or short radar, anything you're looking to trade or add to the portfolio?
I kind of mentioned a couple of different names before. I would tell you that, those are the ones that I'm rolling up my sleeves on. For me, it's not a scattershot approach. I try to have my list of investments, and I have my list of, what I call contenders, and I try to separate them out, if you will, from the pretenders. So I don't want to be buying those. So I would say that, those are kind of my big ones right now. But, I'm always looking for new ones, and obviously, these pullbacks are pretty interesting to me. I'll tell you what I'm not looking forward to is restaurant companies. I'm not looking into retailers at all, despite the back-to-school season. And when I say retailers, I mean companies, like physical storefronts. I'm much more of a buy the bullets, not the guns kind of guy. So far more interested in Under Armour, Nike, those type of companies that are benefiting from some international exposure or growing international exposure, but also are riding this wave of, let's call it, athleisure.
Yeah, absolutely. Athleisure is huge right now. Well, let's take one final look at the overall market. I mean, you can't talk about it without talking about the Fed and interest rates, especially after this week's market action. I mean, and some of the sentiment we got from the FOMC minutes earlier this month. Do you think we're on track at all to see a rate hike next month?
I have been saying for some time that I did not see the Fed hiking rates in September. And there were two factors for that. I'm fortunate enough that I teach some graduate classes up at New Jersey City University, which center in on the financial markets and capital markets, as well as discussing, the Fed. And we have to remember that the Fed's got a dual mandate, right? Everybody thinks about, the growth of the economy, but when you look at it, the dual mandate centers on employment and it centers in on inflation. Okay, so when we look at employment, yes, we've seen the old 5.3% unemployment rate, but we all know that it's like Swiss cheese. There are so many holes in that number that in some cases, we should almost toss it out, forget about it, use something else. And I tend to look at, whenever I do stock valuations or look at data, I really try to triangulate, and TRI is the first in there. So I try to look at 2 or 3 different indicators. To me, the more telling ones have been payroll to population and, of course, the labor force participation ratio, which, despite the drop in the unemployment rate, are, they're at extremely low levels. We also know that we've seen a lot of part-time work. Thank you, Obamacare. We know the types of jobs that are being created are lower wage jobs, so not very low quality jobs. And I think the Fed sees that. But on this inflation front, though, we're nowhere near the 2% that the Fed's been looking for. And I believe the last CPI report showed that over the last 12 months, 0.2%. So to me, when you look at these factors, it's really hard to say, the Fed is going to do it. I just don't see it. I think maybe we see it, at the end of the year, depending on the tone of the economy. But what we've seen with the slowdown in China, some of these other concerns, remember, there's slowdown in Russia, slowdown in Brazil. I think the Fed is going to look at these and go, if we move now, not only will we be, slowing things down, we're going to be making a strong dollar even stronger. And remember, this strong dollar is really starting to crimp over the last few months our net export orders. We've seen other countries that have devalued their currencies, directly, indirectly, call it what you will, like the Eurozone. We're seeing various countries see a huge pickup in net export orders. So, if we do tighten, that means the dollar will get stronger. That means we'll be even less competitive on the global stage. And I don't think that's where we need to be right now.
We're on the line with Chris Versace. He's the portfolio manager of the Thematic Growth Portfolio. Got just about a minute left here with you, Chris. Final thoughts on the market for our traders and investors.
Well, what I would say, and this is something I've been writing about as I do every week at Real Money Pro over at thestreet.com, is look, the market is volatile. I expect it to be volatile in the short term, right? We need to have growth expectations reassessed for the global economy. The benchmark for most people is earnings for the S&P 500. That gives you your market multiple. We need to see this happen. So what you should be doing is rolling up your sleeves, taking a hard look at companies, looking for catalysts, looking for companies, that offer great upside as well as modest downside. Even after this pullback, you may not find it, but you want to build that list because, again, this volatility is going to continue. And, I think if people do that, they'll be able to sleep at night. And Lord knows I don't do it enough, but I do enjoy it when I do.
We've been on the line with Chris Versace. He's portfolio manager for the Thematic Growth Portfolio. Chris, thanks again for joining us this morning. We really appreciate your market outlook, and we'll have to bring you on again soon.
I thank you so much for having me, and I would more than welcome being back on.
All right. Have a great day.